The financial advisory industry is facing an existential moment that most professionals are too uncomfortable to discuss openly. For decades, financial advisors have built their reputations on something that it seemed irreplaceable: human judgment, personal relationships, and the ability to understand a client's unique financial situation. But in 2025, that advantage is evaporating faster than anyone anticipated. Artificial intelligence is not just assisting financial advisors anymore, it is becoming capable of doing their actual job. The question is no longer whether AI could replace financial advisors, but rather how many will actually get replaced and how quickly it will happen. The numbers suggest the transformation is accelerating at an unprecedented pace. By 2028, artificial intelligence-driven investment tools are projected to become the primary source of personal finance advice for approximately 80% of retail investors. That is not a distant future, that is 9 years from now. Today, 29% of people who use artificial intelligence applications like GPT have already accessed financial advice through these tools. The robo-advisory industry, which pioneered the automation of investment advice, has experienced explosive growth that traditional advisors cannot match. Robo-advisor assets under management grew by 58% year-on-year, according to Morgan Stanley's 2024 Wealth Management Technology Report, with artificial intelligence driving much of this expansion through improved performance and enhanced client experience. The financial services industry is watching this transition unfold with a mixture of fear and resignation. 40% of financial advisors now worry that artificial intelligence will replace them entirely. Financial institutions themselves are moving with stunning speed. 96% of financial advisors believe that generative artificial intelligence can revolutionize client servicing and investment management. 97% foresee significant impacts on their work. These statistics paint a picture of an industry knowing change is coming but uncertain how to respond. The democratization of wealth management, perhaps the most significant advantage artificial intelligence brings to financial advice, is democratization. Traditional financial advisors primarily serve wealthy clients because the economics work only at scale. An advisor managing 50 clients with an average of $200,000 each generates $110 million in managed assets. A typical advisor might charge 1%, earning $1,100,000 in fees annually. For smaller clients, someone with $50,000 to invest, this model makes no sense economically. Artificial intelligence changes this equation completely. The cost to serve a client with $50,000 is nearly identical to serving a client with $5 million. Betterment accepts accounts with no minimum. Wealthfront requires only $500. Vanguard's digital advisor has a $3,000 minimum. These are not price points that work for traditional advisory. They work because artificial intelligence has automated away the variable cost of providing personalized service. The United States added 379,000 new millionaires in 2024, more than 1,000 per day. This population needs investment advice. Rather than turning to expensive traditional advisors or struggling to manage their own portfolios, they are increasingly turning to artificial intelligence-powered platforms. These platforms are capturing assets and loyalty at a scale that threatens to leave traditional advisors managing only the ultra-wealthy with truly complex situations. Where humans still win, for now, despite all this evidence, some advisory firms are thriving while others struggle. The distinction comes down to understanding what artificial intelligence actually cannot do. A spreadsheet can calculate how much you need for retirement, but it cannot ask how you feel about retiring. An algorithm can rebalance a portfolio perfectly, but it cannot pause when a client says in a worried voice, "I am anxious about my kids handling this inheritance." A machine can optimize tax efficiency, but it cannot provide the emotional reassurance that matters most during periods of market volatility. During the 2008 financial crisis, clients received identical investment advice from multiple sources, but outcomes diverged dramatically based on their advisor's ability to provide emotional support and rational perspective. Investors who stayed the course and trusted their advisor's guidance emerged wealthier than those who panicked and sold. The human advisor provided something the algorithm could not: a steady hand during chaos. Human advisors also handle situations requiring judgment that extends beyond pure financial analysis. Planning for a family business sale, navigating a special needs trust, managing generational wealth transfers, and counseling clients through major life transitions. These require wisdom, empathy, and human judgment that current artificial intelligence simply cannot replicate. A client who has built a successful business over 20 years is not just asking for a portfolio, they are asking for guidance on a profound life transition. Research from MIT Sloan found that while large language models can provide sound financial insights when augmented with finance-specific modules, they require human oversight to explain nuances and build the rapport that underpins long-term client relationships. The hybrid model appears to be winning. Human advisors using artificial intelligence tools to enhance their capabilities rather than being replaced by them entirely. The regulatory and behavioral barriers to full replacement. Despite artificial intelligence's impressive capabilities, significant barriers prevent immediate replacement of human advisors. The first barrier is regulatory. Financial services remain one of the most heavily regulated industries. The Securities and Exchange Commission has explicitly warned against algorithms favoring proprietary products over client interests. In July 2023, the SEC proposed rules to prevent broker-dealers from using predictive analytics in ways that prioritize firm interests over investor needs. Artificial intelligence systems operating in this environment require audit trails, explainability, and ongoing human oversight. The second barrier is behavioral. Humans have a deeply ingrained preference for working with other humans in high-stakes situations. Despite decades of evidence that robo-advisors deliver superior returns at lower cost, many investors still prefer the reassurance of human contact. Interestingly, advisors using artificial intelligence tools report dramatically higher client satisfaction scores. Clients appreciate that their advisor has more time for actual conversations because administrative burden has been eliminated. The third barrier is trust itself. Trust is built through repeated interaction, understanding, and demonstrated competence over time. A client cannot develop trust in a machine the same way they can with a human. Institutions like Betterment have discovered that the ideal model is not pure automation, but rather human advisors augmented with artificial intelligence tools. Betterment's premium plan provides unlimited access to certified financial planners for an additional fee, and this hybrid offering has proven more successful than pure robo-advisory alone. Hybrid everything, the trajectory is unmistakable. The future of financial advice will be predominantly hybrid. Artificial intelligence handles what it does better: analysis, optimization, compliance, reporting, and portfolio management. Humans handle what they do better: relationship building, emotional support, complex judgment, and navigating life circumstances that extend beyond pure financial optimization. Less than 20% of an advisor's time today is actually spent in client consultations. The majority is consumed by operational and back office tasks. Artificial intelligence is eliminating those tasks at an accelerating pace. EY estimates that artificial intelligence-powered compliance tools can reduce compliance management time by 75%. Goldman Sachs' Enterprise AI Assistant cuts time spent on routine analysis by approximately 60%. These efficiencies mean advisors who adopt artificial intelligence tools can serve more clients, deliver better advice, and focus their limited human time on the interpersonal aspects where they provide unique value. The market is correcting in real time. Major institutions that bet on pure robo-advisory have either been acquired by larger firms or incorporated human advisory options. Smaller advisory firms implementing artificial intelligence tools are reporting 25 to 40% improvements in operational efficiency while simultaneously improving client outcomes. The firms gaining market share are those that view artificial intelligence not as a threat, but as a tool for amplifying human expertise. The uncomfortable truth is this: artificial intelligence will not replace financial advisors, but it will absolutely make obsolete those advisors who refuse to embrace it. The future belongs to advisors who understand how to work alongside artificial intelligence, who use it to automate routine tasks, and who redirect their limited human attention toward the relationships, judgment, and emotional intelligence that machines cannot provide. The age of the traditional financial advisor is ending. The age where human wisdom is amplified by artificial intelligence capability is just beginning.